Welcome to a game-changing video on higher probability breakout trading. You are about to discover the 5 criteria you must have in your breakout entry plan to optimize the chance the price move is going to continue to move in your desired direction. And yes, we're going to give you an example of such a plan as well as part of this presentation. If you're tired of seeing false breakouts after you enter, and if you're serious about achieving more consistency in breakout entries through support resistance levels or pivots or fibs, you're in exactly the right place to do that. Join me, Mike Smith from TraderIQ, and let's dive into the world of higher probability breakout trading together. So why should high probability entries be important to you? Quite simply, the quest for high probability trades is to develop systems that make it more likely a trade moves in your desired direction after entry. This undoubtedly contributes to profit potential, along, of course, with effective and efficient exit systems. As well as primarily looking at price action, we can look for other supporting evidence on price charts to optimize this, such as other indicators, which we're going to look at as we go through this presentation. And subsequently, of course, once we've developed such criteria, we can test and measure the success or otherwise of what we use and refine it accordingly over a period of time. So the first key point of many that I want to reinforce is that high probability entries only matter when combined with appropriate and timely exit strategies. So when we talk about breakout trades, let's look at in a little more detail quite quickly at what we mean by a breakout strategy. It is one of the most popular trading strategies amongst traders internationally across multiple instruments, multiple timeframes, with a clearly defined price point where there is an indication that sentiment has changed should it break through that level. A breakout price can be a simple move through an identified support resistance level, all of which even at a very basic level, we learn how to draw on charts. And Fibonacci and pivot levels may also be used just to reinforce that any approach that we take as part of a breakout trade should be articulated within a written trading plan, not kept in your head. And within that plan, there should be specific and unambiguous criteria. And what this means to you as a trader is it enables you to behave more consistently in terms of your entry. And of course, measure the performance of not only yourself in executing such a plan, but also how various component parts of that plan are working. And we'll make reference to that later as well. Key point I want to reinforce here is you will have a trading edge immediately if you adhere to point 3. Remember, a trading edge is something that you're doing that gives you an advantage over the majority of market participants. And if you have that written trading plan in place with specific and unambiguous criteria, and you're measuring what you're doing, most people don't have that. So automatically, by doing the right thing, that's going to give you a trading edge. So let's look at what goes wrong with breakout trades. Well, it's all about reducing the risk of false breakouts. And what we mean by that is when it looks as though something's going to break out, it might even poke its head above a key level or below a key level if we're going short, only to fall back into a trading range, or in other words, back through that level. So this identify key price point, that can be a support resistance line or a pivot. What we want to see is it hold its price through that level and subsequently begin to move in our desired direction. The problem is, of course, is that often it doesn't. So what we're trying to do here, and when we talk about high probability breakouts, it is having criteria in place, meaning that this is less likely and the price is more likely to move in your desired direction. And there are 5 things to consider, which we're going to do during the course of this presentation. And it is worth reinforcing at this point in time that this is different to retracing back to the key price breakout level, which has just been breached. This will happen frequently. Some would suggest 40 or 50% of the time you'll get it breaking through a key level, retracing to the level it's just broken through, and then it will continue in the direction. So we're not talking about that situation. We're talking about that trading idea of a breakout has failed. Of course, we'll have risk management strategies in place as part of our exit plan to manage that accordingly. So let's start at the beginning. It all really starts with the anatomy of price action. Whenever we're looking at a new strategy or refining an existing strategy that we're using, what we need to do is we need to define quite clearly what we mean by a particular term, such as a breakout. And here's an example here on the GB pound yen, where we've had a number of attempts at a particular price level, and then we've had a close of a candle above that level. Note, it's the close of the candle that's important here, not these wicks that may have tested it along the way. Now, there are other things we can look at on this chart. We can see we've got a volume bar, we can see we've got an ATR, but we'll talk about those later. But just so you're quite clear about what we're wanting to do is we want a breakout that subsequently continues in our desired direction. So when we're doing this, what we do is we look at a number of charts. We start to pick apart what things seem to be working when it does go in our desired direction and vice versa, of course. So let's choose a random chart. Let's open our MT5 platform and we'll choose the GB pound yen now. Let's just bring it up to date. So what we can see here is we had a level of resistance here at 185.27. And we got a breakout move here. Now it hasn't set the world on fire, but it has moved up in our desired direction. So what do we notice about this? Well, first of all, we notice that the close is above. Previous two candles there, it was only wicks that tested that level, there wasn't the close. Second thing we notice is that if we look at volume here, it's certainly above average, but it is a higher volume bar. The third thing we notice is that you can see it's closed near the top of the candle. And you can see there is some space in between this key level we identified and where it closed. So there's a number of different things there that seem to be part of this breakout. Whereas if we look at this potential short trade here, you can see there we're in a consolidation pattern. And if we look here at the candle that we broke through on, you can see it's this one here. What do we notice about this? It didn't go very far is the first thing, obviously, subsequent to entry, within less than 15 pips. But we notice that the candle hasn't closed in the bottom third. We notice that the volume is low. We notice that, additionally, actually, there's another key level at around about that point there. You can see how that was the resistance. And ultimately, that's where it stopped. So the proximity of the next key level down looked important on that. So you can see now how we're just starting to put a story together of what seems to work and what seems not to work. Here's another one back here. So what can we see here? Well, what we can see here is we did have a candle, but there's very little space between this breakout and where that candle closed. So there's not much space there. We did have higher than average volume, but it was actually less than the previous candle. So there's a couple of things there that perhaps contributed to this not working out as it should. And if we take it back, we see a number of times that it actually broke this level, notably just above where my arrow is here, also at this point here and this point here, where it failed to hold the level once it had broken through. So there's, again, a number of things that are striking in terms of a breakout trade that didn't work. First thing we talked about was the price relationship to the candle when it closed. So, in other words, who won the bull versus the bear battle? So you can see here on this breakout trade here, just on this small screenshot, there was the breakout trade. And you can see it closed to the bottom. That suggests the bears won this candle. But on top of that, we got the breakout. So it's that combination of price move plus the candle plus the price closing towards the bottom of the candle if it's a short trade, or towards the top of the candle if it's a long trade. Now, obviously, each candle, although it must be viewed in the context of those around it, should be seen as a bull-bear battle. Close towards the top of the candle, if you're looking at a long trade, suggests the bulls are in control and would logically more likely result in a continuation into the next candle, and of course, vice versa, as you can see on that diagram. Therefore, where the price closes in relation to the range of the candle would seem important. And remember, right at the start, talked about being specific and unambiguous in terms of your plan statements. So perhaps something like the top third or the top quarter would work. But what is also obvious is we need to just do it on the close price. Irrespective of what time frame, irrespective of what asset we're choosing, we need to wait until that candle's closed, because then it's fully mature. We see quite often, as you see out here, this situation occurs that we get something that looks as though it might break out. The wick actually falls through, but ultimately when the candle closes, it's above that. You can see here, we had a number of attempts to breach this level at this point here and didn't actually do it. And ultimately, that breakout never happened and we saw a failure. So using close price is prudent to make sure that everything that you're looking at is mature. So the key point from this is, as with all plan criteria, you must be specific about the relationship between the price and the candle range. So as I've suggested, top half, top third, top 25%, you must plant your flag in one and then trade it consistently. And ultimately, when you've got a critical mass of trades, then you can start to test alternatives against it. Number two is increased volume. Now, volume's given a bad rap by those who trade FX and CFDs, because there are issues about there not being a central exchange. So what you're seeing is tick volume rather than real volume. However, tick volume still remains an indication of buying or selling pressure, because it's the number of times a particular asset has been traded within the life of that candle. And so we can see here, as it moves down with some momentum, we can see volume rising. When it's finished moving downwards and is going to retrace a little bit, then we see volume dropping. You can see at the end of this downtrend here, where we had this small period of consolidation, you can see how the volume dropped off as well. Quite simply, combined with price action and where that price finishes in relation to the candle range and higher volume, you get both of those things together, and it's more likely that that move is going to be robust and go in your desired direction than is the case with the lower volume move. The decision you've got to make about this, and the key point I want to stress, is that you must make a decision as to what actually constitutes higher volume. You can use average volume, you could use higher than the previous bar or bars, but again, what you need to do is articulate it specifically. Another thing that you'll hear me talk about fairly frequently is giving the market some breathing space. Quite often we'll see something test key levels, you'll see in this candle and this candle, and so giving the market just a little bit of breathing space above your key level if going long or below your key level if you're going short avoids this will we or won't we continue in this direction scenario that we see so often. So commonly we'll see wick tests or small closes on smaller timeframes only to see a move back through the key level. So it makes sense that we give it some space between the actual key level and the entry to reduce the likelihood of this occurring. Now, why it occurs is that we've got quite a few people, if we think about this, if you get an uptrend here, we've got quite a few people here expecting it not to break through, but to pull back down. Okay, so you'll have a lot of limit orders there, expecting it to retrace, hit that level, in which case the orders will be filled, and then we get a bounce down. On this side, we've got buy stop orders, expecting that if we get a breakthrough, we will continue in that direction. By the way, on the screenshot, you'll see an example of that retracement back towards that key level that I discussed earlier. So what we want to do is we want to avoid these limit orders and these initial buy stop orders, which market participants know about and will play. So by giving this space, you take that out. The question is, how much space do we give? So using something like an ATR multiple, so for example, 0.3 of an ATR, or average true range, would keep this consistent across multiple timeframes and pricing of different assets, rather than saying 5 points or 5 pips or 10 cents or whatever, something that is very specific to that time frame and that asset class. If we use something that adjusts itself accordingly, then that would appear to be logical. But as with any parameter that you use in your entry criteria, it's always worthwhile testing alternatives so you get the level that's best fit for you after you've developed that critical mass of trades to test against. Again, it's a point that I'm reinforcing regularly. I'm sure you're already aware. Issue number 4 of 5 is key level proximity. This is our bandwagoning potential, as I call it. Think about this. If you had two similarly priced charts, and the first one had 100 points to the next potential resistance level, and the second had 30 points to the next potential resistance level, which would you choose? My guess is you're going to choose the one with 100 points potential, and that is because that's what everybody would do. Hence, if there is a greater chance of a bigger move, because there's nothing going to stop it, nothing going to get in the way, no other key levels that it might pause at, then that becomes more attractive. The more upside for a long trade, the more likely it is to be attractive to other market participants, and so that will increase the number of traders who are interested in this and potentially increase momentum of a move. We see here an example of this. So you see here, this was the previous resistance. It broke through there, and of course, it got stuck there. So once again, The challenge is that, as well as being priced differently, different instruments, even within the same asset class, might have different average volatility. So we can't use pips or points because if we compare, say, for example, the Aussie Kiwi, which is quite a highly correlated currency, to the Aussie Yen, which is far, far less correlated, then a 15 pip move on the Aussie Kiwi is quite significant potentially in terms of its average movement, whereas a 15 pip move on the Aussie Yen is nowhere near as significant. So, in order to compensate for that, it would be preferable to use a multiple of something that measures this, such as the ATR again, rather than a specific points, pips, or cents figure. So, when you're looking at a chart, look at what the ATR or the average true range is doing and say, well, look, the distance to the next resistance point is 1.5 ATR or 2 ATR or 3 ATR. And then you can write that as a specific criteria in your trading plan. So for me, I would want at least 1 to 1.5 risk reward ratio or 1 ATR to 1.5 ATR. There's an example for you. Now, the final one of the 5 is look at the long-term trend. That old rule of trade with the trend is there for a reason. The reality is, even if it is a common market cliche, there is sufficient evidence that justifies this as an approach and would suggest a price move has more potential upside if it is in the direction of a longer term trend. Now, there are a couple of options here for looking at this. Obviously, we can just look at a different time frame. So if we're trading a 30-minute chart, then we could look at what's happening on the 4-hourly chart as an example. Or trading on the 5-minute chart, we might look at the hourly chart just to make sure it's in the right direction. The other option is to put a longer term moving average, which looks obviously at the trend over a longer period of time than perhaps the 10 and the 20 that you'll see on this chart here. This red line here is the 50 moving average. So what we see here is not only does this candle break out on high volume in the top third, but it also has now moved over the 50 EMA, suggesting that this has changed from downtrend and is moving into uptrend. Again, you need to plant your flag, make your choice. If you're going to look at the longer time frames, then of course you've got to articulate clearly within your plan which longer time frames you're going to use to be consistent, or which longer period moving averages again as standard. And then you can test alternatives and refine at a later stage. So there's your 5 key things that if you put in place will undoubtedly increase your probability of your breakout trades going with you. And so this is what it could look like. So this is a potential entry plan for a breakout trade. So a close price or an identified price level in the top third of the candle or bottom third if it's short. Increased volume above average or from the previous bar, depending on which measure you choose to use. Minimum proximity of the next key level, more than 1.5 ATR level. Minimum space between the key level and your entry point of 0.3 ATR, and consistent with however you're going to define your longer term trend. So say, for example, it's got to be over the 50 EMA. Now, as you see from those criteria, they are specific, they are unambiguous. It's a yes or no. Have you done it or not done it? There's your entry plan. Now, the challenge I lay down to you, of course, is go and have a look. But don't forget that ultimately, entry is the easy bit. It's when we get to exits that we need to get robust. So management of potential capital loss and management of potential profit loss if a trade does start to go in your direction. These are vitally important. And you need to give these as much airplay, as much effort, as much energy as you would any entry strategy. So we're not going to do a session like this without suggesting some actions. And of course, if you're watching a video like this, you could just watch it, walk away, say thank you very much. That's okay. I might even smash a like or subscribe to hear more later. But really, the thing that will make a difference is if you follow through. So if you commit to taking action to discover whether any of these ideas we presented today will contribute to higher probability breakout entries for you and your trading world. Start by looking back at recent breakout trades you've taken. What would have happened if you'd added these rules to your trading decision making? Would it have kept you out of trades that didn't go your way? Would it have enabled you to make decisions quickly and easily so you didn't miss out on some of the profit potential that was there? And of course, start a forward test. Look at things that pop up over the next few days, irrespective of what instrument, irrespective of what time frame or asset class you're looking at. Then you can start to review your plan accordingly. Make amendments that are right for you to improve, as we all try to do, our dollar outcomes from our trading. I hope that's been useful. Thank you for the support you always give in terms of liking videos, leaving comments, subscribing, whatever it is. But most of all, thanks for your time. Thanks for watching. Trade safe. We'll catch you again soon. Bye bye for now.